If you're looking for an investment that offers substantial yields and frequent income, look no further. The Roundhill N100 ODTE is a newly launched ETF that promises an impressive 30% yield with the added benefit of weekly dividends. This ETF is making waves with its innovative approach. It's not just another income fund, it utilizes a synthetic covered call strategy that is designed to maximize returns and provide consistent income. This fund is targeting those who are looking for more frequent payouts without compromising on potential growth. But how exactly does QDTE generate such high returns? Is it the right fit for your investment strategy? Stay tuned as we break down the details and discover the potential of this remarkable ETF. The Roundhill N100 ODTE Covered Call Strategy ETF, known by its ticker symbol QDTE, represents a new and innovative approach to generating income through ETFs. This ETF is part of Roundhill's series of specialized funds focusing on high-yield strategies that appeal to income-focused investors. The name N100 ODTE stands for NASDAQ 100 and 0 days to expiry options, indicating the fund's primary focus on the NASDAQ 100 index and its use of options that expire within the same day they are traded. Launched a couple of months ago, QDTE quickly garnered attention due to its unique strategy and the promise of substantial yields. The initial reception has been notably positive among investors who are keen on high-yield opportunities. The excitement is particularly driven by the ETF's promise of weekly dividend payments, a feature that sets it apart from many other income-focused funds that typically distribute dividends monthly or quarterly. This feature makes QDTE particularly attractive to those looking for regular and frequent income streams. The synthetic covered call strategy employed by QDTE is central to its operation and appeal. Unlike traditional covered call funds, which hold the underlying assets and sell call options against them, QDTE utilizes a synthetic approach. This means it does not hold the actual securities of the NASDAQ 100. Instead, it buys deep in the money call options to replicate the performance of these securities. This method allows the fund to gain exposure to the price movements of the NASDAQ 100 without the need for significant capital outlay that would be required to purchase the actual stocks. Each morning, the fund sells out-of-the-money call options on the NASDAQ 100 index. This means that the strike price of these options is higher than the current market price of the index at the time of sale. If the index does not rise above the strike price by the end of the day, the options expire worthless, allowing QDTE to pocket the premium as income. This process is repeated daily, aiming to generate consistent income from the option premiums. The strategy of selling ODTE call options is designed to maximize income while minimizing risk exposure. Since the options expire daily, the fund is not exposed to the overnight risk that longer-dated options might entail. This allows QDTE to adjust its position rapidly in response to market movements, thereby aiming to maintain a steady income stream even in volatile market conditions. But how is it comparable to the others? Historically, there have been a few ETFs that attempt to capture the interest of investors by offering weekly dividend payouts. Notably, SoFi launched two such funds a few years ago, WKLY and TGIF. These ETFs, aimed to provide consistent weekly dividends, appeal to investors who desire frequent income streams. However, despite their innovative approach, both WKLY and TGIF were eventually liquidated. The primary reason for their failure included insufficient demand and the relatively low yield they offered, which was around 2 to 3%. While the idea of weekly dividends was attractive, it was not enough to sustain these funds in a market where higher yield alternatives, such as the high interest savings account, were readily available. In comparison to QDTE, the SoFi ETFs had a more traditional structure and did not employ synthetic strategies. This made them simpler to understand but also limited their potential yield. QDTE, with its synthetic covered call strategy, aims to provide a significantly higher yield, over 30%, by using a more complex and active approach. When comparing QDTE with traditional covered call funds like QQQX, the difference becomes even more pronounced. QQQX, a well-known traditional covered call ETF, holds the underlying asset of the NASDAQ 100 and sells call options against them. This strategy generates income from the option premium, but also caps the potential upside of the fund, as the options sold limit the gains from the underlying security's price appreciation. QDTE, as we had mentioned, uses a synthetic strategy which does not involve holding the actual stocks of the NASDAQ 100. This allows QDTE to generate similar returns to the NASDAQ 100 without the need for significant capital investment. Moreover, by selling ODTE call options, QDTE can adjust its positions daily, aiming to optimize income generation and manage risk more effectively than traditional covered call funds. And when we analyze the volatility and performance patterns of QDTE and traditional covered call funds like QQQX, they also differ. Traditional funds like QQQX tend to have more stable dividend payouts and less volatility in share price. This stability makes them more predictable for investors who rely on steady income. However, QDTE's synthetic strategy can lead to more significant fluctuations in both price share and dividend payouts. For instance, QDTE's dividends have varied significantly, from as low as 9 cents per share to as high as 37 cents per share within just a few weeks. So, what should you do to avoid the high volatility? Diversification is a fundamental principle in investment portfolio management, aiming to reduce risk by spreading investments across various assets and sectors. This approach helps to mitigate the impact of any single asset's poor performance on the overall portfolio. For investors, diversification means not putting all their eggs in one basket, thus protecting against significant losses if one investment underperforms. It provides a smoother return experience over time, as gains in one area can offset losses in another. The Roundhill N100 ODTE Covered Call Strategy ETF exemplifies this principle through its diversified exposure to the NASDAQ 100 index, which comprises 100 of the largest non-financial companies listed on the NASDAQ. This exposure includes a range of sectors such as technology, consumer services, healthcare, and more, offering investors a broad market presence. In contrast, some synthetic covered call funds are more narrowly focused. For example, yield-max ETFs often concentrate on a single sector or a few select companies, which can increase risk due to the lack of diversification. Comparatively, QDTE's approach offers a more balanced risk profile. By replicating the NASDAQ 100 through synthetic covered call strategies, QDTE provides investors with the potential benefit of a high-yield income while maintaining diversified exposure to a wide range of industries. This reduces the risk associated with sector-specific downturns, making it a more stable choice for investors seeking both income and growth. Investing in high-concentrated sectors, however, presents its own set of risks and rewards. On one hand, concentration in a specific sector, like technology, can lead to specific gains if that sector performs well. Tech stocks, for example, have historically offered substantial growth potential, driven by innovation and consumer demand. Funds focused on this sector can experience rapid appreciation during boom periods. On the other hand, the lack of diversification in highly concentrated funds can lead to heightened volatility and risk. Sector-specific downturns can have a severe impact on these funds. For instance, if regulatory changes or technological disruptions negatively affect the tech sector, a fund heavily invested in tech stocks could see significant losses. This risk is exacerbated for synthetic covered call funds that rely on option strategies, as these instruments can amplify both gains and losses. QDTE, with its diversified exposure, offers a buffer against such risks. While it still carries the inherent volatility of the Nasdaq 100, the broad range of sectors within the index helps to spread risk more effectively than a fund focused on a single industry. This makes QDTE a potentially safer option for investors who want high yields without the extreme risk associated with less diversified investments. So, is QDTE worth the investment? Now, we have reviewed many ETFs, and the Roundhill N100 ODTE Covered Call Strategy ETF and its counterpart, the Roundhill S&P 500 ODTE Covered Call Strategy ETF, certainly stand out. They represent a fresh approach to income generation through synthetic covered call strategies, promising high yields and weekly dividends. While the potential returns are impressive, it's essential to consider these ETFs within the broader context of an investment portfolio. QDTE and XDTE offer intriguing opportunities, particularly for investors seeking to maximize income. The strategy of selling 0 days to expiry options provide a continuous stream of income, capitalizing on daily market movements. The high yield, especially the 30% offered by QDTE, is undeniably attractive. However, these ETFs come with a higher level of complexity and risk, which investors must be willing to navigate. One key piece of advice is caution against relying heavily on these ETFs for retirement income. The high yield and frequent dividend payouts might seem ideal for building a retirement portfolio, but the inherent volatility and unpredictability of the income can be problematic. Retirement income should be stable and reliable, allowing for predictable budgeting and financial planning. The dividends from QDTE and XDTE can fluctuate significantly from week to week, making it difficult to depend on them for consistent income. Instead, these ETFs should be considered as part of a diversified portfolio, including QDTE and XDTE in a broader mix of investments can enhance overall yield while spreading risk across different assets. For example, combining these high-yield ETFs with more stable income-producing investments, such as dividend-paying blue-chip stocks or traditional covered call funds, can provide a balanced approach. This strategy allows investors to benefit from the high income potential of QDTE and XDTE without exposing their entire portfolio to the associated risks. Furthermore, it's crucial to understand the complexities of synthetic covered call strategies. These ETFs are not straightforward and require a certain level of financial literacy to manage effectively. Investors should ensure they fully understand how these funds operate and the risks involved before committing significant capital. For those new to option-based strategies, it might be wise to start with a smaller allocation to QDTE and XDTE, gradually increasing exposure as comfort and understanding grows. In terms of potential, I believe QDTE and XDTE have a place in the portfolios of income-focused investors who are comfortable with higher risk and complexity. Their innovative approach to generating income through ODTE options can offer substantial rewards, but it's essential to approach them with a clear understanding of the associated risks. Monitoring the performance of these ETFs over time and staying informed about market conditions will be crucial in managing these investments effectively. So, QDTE and XDTE present exciting opportunities for enhancing portfolio income. However, they should be used as part of a diversified investment strategy rather than as primary sources of retirement income. By carefully balancing these high-yield ETFs with more stable investments, investors can enjoy the benefits of their innovative strategies while managing risk effectively. So, what are your thoughts on the Roundhill N100 ODTE Covered Call Strategy ETF? Is it a compelling addition to your investment portfolio? Let us know in the comments below. If you enjoyed this video, please give it a thumbs up, subscribe, and turn on the notification bell for more amazing videos.